Okay, so we're ready to start. I hope you guys still have some energy, right, to listen a bit more about liquid restaking, stablecoins, collateralization, risks associated. My name is Marcin. I'm one of the co-founders of Redstone Oracles, which is the fastest growing oracle on the market right now. We've recently announced our $15 million Series A, building an AVS on top of EigenLayer. And also we specialize in pricing yield-bearing assets, such as liquid staking tokens, liquid restaking tokens, stablecoins with native yield built in, and so on. Today, we are going to talk with experts on the stablecoins and collateralization. So I will use the first minutes for everyone to say who you are, your name, and what project you represent.
Yeah, 100%. Thanks for the intro, Marcin. My name is Chunda. I'm one of the co-founders of Ion Protocol. Ion Protocol is a lending platform and native yield platform that supports the building of native yield assets for rollups and app chains across the Ethereum and other ecosystems.
Yeah, GM, I'm Ethan, one of the co-founders of Ebisu Finance. We're doing a CDP stablecoin collateralized by restaked assets. So currently evaluating all of the EigenLayer LRTs, as well as some of the restaking tokens from other restaking platforms. Yep.
I'm Wormhole. I'm the founder of llamarisk, and we're a risk service provider. Many of our clients are decentralized organizations such as Curve, Aave, most recently YieldNest, which is in a liquid restaking protocol. And we offer transparency reporting to help users understand the risks that are involved with interacting with various types of assets that they're interested in onboarding to their platforms. So our main purpose is to increase transparency across the ecosystem.
Hey everyone, my name is Walter. I'm a data scientist at Gauntlet. Gauntlet is a crypto-economic research firm specializing in quantitative optimization at the forefront of DeFi. So we do work in the restaking space, doing research on this front, assisting with EigenLayer, helping out with LRTs, looking at problems in the space.
Excellent, thank you. 4 million ETH. This is how much is restaked right now with liquid restaking token protocols. Pretty a lot. At current state, it's $12 billion. I know we wish it was more. Maybe after ECC it's going to rebound again. But not talking about prices, talking about the use case, stablecoins have a specific, some stablecoins have a specific dynamic, which is called CDP, collateralized debt position, where you lock a collateral, for example, liquid restaking token, and then you borrow against a stablecoin, and you hope that this LRT will accrue yield, and also ETH, which is underlying, will rather either stay or appreciate rather than depreciate. Because if it depreciates, then at one point you can get liquidated, hitting the liquidation threshold. And now, as we have experts over here, do you believe liquid restaking tokens are the perfect collateral for these kind of CDPs? Or maybe it's a mix of like T-bills and some real-world assets, and then LRTs. What are your thoughts? Maybe Wormhole, maybe you can start as an expert on the risk side.
So I think that liquid restaking is of particular importance to really elucidate all of the mechanisms that are behind them, because although they may be a very simple product to interact with, it's as simple as taking your ETH or your liquid staking token and depositing it into the liquid restaking protocol to earn additional yield. Really, what's underpinning it is many layers of potential risk, which is analogous in some ways to liquid staking, which we're all quite familiar with at this point, since the market's had a chance to mature over the past year or so, since the Shanghai upgrade last year. But because it is such a simple product to interact with, it's of especially high importance that we dig into the underlying risk vectors that are involved with them. Because many of these liquid restaking tokens may have multiple underlying assets that are collateralizing them. So you're exposed to a much wider risk surface area. And of course, we're going to talk more about the AVSs and EigenLayer, which is underpinning these services and all the risks that are involved with these new types of AVS services that are coming online.
Yeah, I think like to add on top of that, really what you kind of just outlined there is the idea that with restaking and with AVS risk holistically, what we've done is basically created a new type of asset class and a new form of risk that really hasn't permeated the crypto ecosystem before. I like to think about it or term it as like infrastructure or network risk, effectively risk correlated with the kind of stability and sanctity of a network underlying some kind of microservice or actually other network. And I think the thing that's really interesting here is when we've thought about stablecoin design holistically, since the birth of crypto, we've always focused on underwriting market volatility and market risk. And although, if you're restaking with ETH, you do have to use those same mechanisms to underpin the stability of stablecoins with ETH-based restaked assets. If, let's say, we ignored ETH-based restaked assets existed and we focused on USD-based restaked assets, really the only thing we would be underwriting is the stability of kind of these networks that we're underwriting. I think the biggest question for us is thinking about this kind of alternative risk class as whether or not this is something that we'd want to diversify into in terms of divesting away from market risk and traditional ways of underwriting market risk. And whether or not the kind of risk profile is similar to the market risk that other asset-based stablecoins are usually derived from. And I think my personal opinion is that I think infrastructure risk is a lot lower, and financial markets around infrastructure risk and network sanctity are going to be one of the largest and most prominent crypto-native markets going into the future.
Yeah, maybe I can speak like at a little higher level why LRTs would be interesting as collateral for like a CDP stablecoin. The general hope is that in many of the CDP designs, over-collateralization is like one of the biggest barriers to stablecoin issuance because it's relatively less capital efficient than issuing something one-to-one, like how USDC does it with their reserves. So the potential for like a yield-bearing collateral where that yield is derived from like a fully on-chain permissionless source is really attractive to like stablecoin builders. In a sense, if you're familiar with like models like Liquidity, it would be like where the yield is helping to repay the debt position consistently, or in Liquidity v2, it would be helping to offset the user's interest rate they pay when they take an outstanding loan. But to answer the question whether it is like the ideal collateral, I think right now it's like much too nascent of a asset class to tell. Like us as a LRT-backed CDP stablecoin, like Wormhole alluded to, are really focused on underwriting the specific risks associated with each LRT. And that risk-reward ratio is like not clear right now whatsoever. It relies on the restaking platforms enabling mechanisms like slashing and payments, which are like the biggest risk and then the biggest driver for like rewards, as well as like quantifying those risks and rewards and determining like what are safe parameters to onboard this collateral for stablecoins, like collateral ratio, like deposit caps per LRT, because like, yeah, once slashing goes live, we're trying to compare is the rewards from the payments worth taking on that incremental risk and by how much. So yeah, that's at least how we're thinking about it.
Yeah, I'd like to add on to what Chunda and Ethan have mentioned. There is a time dimension aspect to LRTs, right? Because like the other panelists have mentioned, the slashing payments mechanisms have not gone live yet. So currently LRTs are essentially LSTs, right? We're all familiar with LST risk, or hopefully we are familiar with LST risk at this point. There have been no major slashing events with LSTs. Can we quantify the delta of LRT risk with respect to LST risk? And given the number of AVSs live, it will be hard to say right now, right? We can also factor in a bunch of correlations within these slashing risks as well. Although a lot of this is still like fairly undetermined, we need to see like the actual data. Nonetheless, these sort of unknown manifestations of these risks can still happen. That's one aspect of it. The second aspect of it is, of course, the natural like market liquidity for these tokens as well. If you consider like a hierarchy, naturally ETH has the most liquidity, whether it's centralized or whether it's decentralized. The next level down is LSTs, and the next level down is LRTs. With a large number of LRTs coming onto the market, you can imagine the main players to capture a large portion of the liquidity on the market. And the tail end of the LRTs will have a tougher time attracting this liquidity as well. Of course, they can pull different levers to make sure they have that ample liquidity, but time will tell.
I'd like to just bounce off of something you said early on in what you were saying, that LRTs are essentially like LSTs at this point. And I just want to be very clear about the limitation of where we are with the LRT ecosystem. Eigenlayer is essentially in beta testing right now. So there are no slashing conditions. And therefore, if you are an LRT protocol and you're thinking about your risk exposure to the various AVSs that are available, you don't really have any risk at this point, which doesn't mean that the LRT protocol should just not worry about it and just YOLO into every AVS available. We still need to be diligently thinking about when slashing conditions are going live. We need to be prepared for that, and we need to understand what specific slashing conditions does the AVS introduce, and whether those are favorable to the restakers. And fortunately, node operators and restakers are aligned in their incentive to understand what those are. And we do the best that we can to try to understand what are the idiosyncrasies of the AVSs, what are the centralization vectors that could potentially lead to accidental slashing to occur. But ultimately, we have to be clear that LRTs are very limited in what kind of underlying service that they're actually introducing today.
That's a really good point. And also representing here an AVS, so Redstone is building an AVS. You have a marketplace, so Eigenlayer marketplace. On one side, you have people who throw in ETH or LST and count on the highest yield possible, naturally. And on the other hand, you have AVSs that take this restaked security and will have to pay for all the restaked security that they are using, right? So from my perspective, an AVS is important how much I have to pay, and also the slashing conditions. So for people that are not familiar, Eigenlayer is releasing updates in milestones. And the milestone with slashing introduction is not live yet. I'm not sure what's the latest timeline, but naturally, it's also not a trivial concept to implement, like mathematically determine like when a node or like an actor should be slashed. So it's not easy. And now to a bit also engage you in the conversation. Have you heard of a company or entity called Alameda Research? Raise your hand. Fantastic. So for those who don't know, these were people that really liked to play with fire, and turned out they are not like fireproof. And talking about the risk with AVSs, do you imagine there is a scenario where there is like an Alameda Research of AVSs that is taking all the risk, all the crazy stuff, just to get all LRTs to restake with them to get the highest yield, and in the event of the black swan, then they are going to collapse and take maybe not the whole restaking sector, but a part of it down with itself, with the fallout. Any thoughts about that? And if there is such a case, what would they be doing, like these AVSs, to truly like increase the risk that is out there?
Yeah, I think it's something that doesn't exist yet, an AVS that is positioned to do so. But I definitely think it's an inevitability that it will exist in the future. So to think about like why is there not an AVS that currently exists that focuses on, or that could introduce this type of risk? So most AVSs today are infrastructure projects that focus on what we call objectively attributable kind of faults, right? Which means that these are services where you can point to some on-chain or some verifiable action, and then objectively attribute to whether or not you should be slashed via looking at some piece of like objectively verifiable data. When you look at these types of systems, you effectively have full transparency on what are the conditions that could lead to slashing. These are objectively attributable faults, that's what we call them. And then the problem is when you introduce subjectivity to these faults, so let's say you are subjectively attributing to the outcome of a decision in a prediction market, now you introduce a kind of position where if other AVSs are sharing security with this subjective outcome, you run into a situation where bribery can occur, where malicious node operators who may have some kind of vested interest could circumvent or subvert the system. And it's really important to, one, like, I think, have a lot more literature and conversation around what are these, it's kind of like a taboo topic to talk about this idea of AVSs that could undermine restaking platforms, especially restaking platforms that focus on shared security. I think it's another thing as well to push a lot of responsibility onto restaking platforms to actually impose constraints on where people can actually source security and how they can source security, or at least clearly delineate to their end users, the LRTs and all the other stakeholders in the ecosystem, the difference between these two types of faults and how they can actually source capital from these restaking platforms.
Yeah, like I think this question is kind of getting at the risk profile of LRTs. So aside from like liquidity, the smart contract implementation of LRTs, one of the main vectors we're looking at is like what AVSs they're securing. Different than LSTs, when restaking platforms are matured, LRTs are kind of acting as risk managers. They're the ones choosing where to delegate their users' ETH, which operators to delegate them to, and which AVSs those operators are securing. So in the case described in the example, like for the LRT to have motivation to secure this Alameda-like AVS, there would have to be like substantial yield payout in order for them to justify that. And the more ETH that's delegated to this AVS, the more diluted that yield gets. So just some details about like how that would actually work. And yeah, I think that's why when evaluating LRT as collateral, it's a little bit harder than LST because you have to look at the idiosyncratic differences between each AVS. What are like the objective slashable faults that each of these AVSs is is imposing, and like yeah, I'm not sure if that case would play out. Like I think that AVS at its core has to use the restaking platform to generate some sort of outsized value. Like they're renting economic security, ideally like cheaper than they could get elsewhere, and they should be using that to like provide a service to the market that creates outsized value. If they do so, they'll be profitable, and they can use that profit to incentivize more security if they need it. But yeah, I think hard to imagine like what kind of an AVS would require so much security and be so profitable that it would be able to pay out so much and then go on to be malicious and cause like a black swan event. It's a possibility, but yeah, just interesting to think about what that would actually look like.
Yeah. Oh, sorry. You can also spin it on its head as well. Like Marcin, you guys are building an AVS, right? Naturally, you can select which operators you want to help secure your AVS as well. Building off of what Chunda and Ethan said, from an LRT's perspective, there's not really a reason, or like there can be many reasons, but these are things LRTs think about when they choose which AVSs to secure. If an AVS is mindful or like sophisticated about which operator set it's going to use to help secure it, naturally we'll also consider, hey, which other AVSs are these operators securing? Do I want operators that have higher likelihoods of getting slashed to be securing my own network? How does that impact my own security? So from an AVS's perspective, they'll probably want to be as cautious, as diligent as possible when choosing these operator sets.
So I'll just take a step back and look at sort of the big picture of the trajectory of the liquid staking ecosystem, which really has been more or less fully developed since last year springtime. And over the course of the past year, we've seen a number of new up-and-coming liquid staking protocols, and more recently, obviously, liquid restaking has really had its time to shine. And over the course of this past year, or we could even go back further than that, we've seen a trajectory where if you look at the amount of ETH staked in the network, it's up and to the right. We're essentially in a 2-year-long bull market of Ethereum staking and liquid staking, which people might not, it might be easy to overlook that because it doesn't have a speculative number attached to it, and there may be less direct sort of euphoria that you experience about that. But we should understand that we've been moving further and further across the risk curve as we introduce more exotic products with more composability risk attached to them. And so when going back to what you're talking about, how could an Alameda or an FTX kind of occur in this space? And it's just that we are all victims of the behavior of everyone, and even the builders in the space. When the consensus of speculators and just the environment that you're working in becomes much more aggressive and further on the risk curve, you have to keep up. And so it's something that we always have to keep ourselves in check about, especially in this Ethereum staking market, because we're all unified by perhaps some kind of bias in favor of Ethereum. And so that makes it even more important that we're always checking our biases and making sure that we aren't allowing ourselves to go too far down the risk curve, right?
Yeah, in my opinion, the main reason we are talking so much about risk when talking about LRTs versus LSTs is the complexity. Because LSTs is nothing else as Ethereum, there's staking, you create a liquid staking on top of that, and it has to be ETH, at least for now, and it has to be staking Ethereum, like protecting Ethereum itself. So to me, like for example, Lido could be like right now actually it is like a specific use case on top of EigenLayer. Like people just throw in ETH and they get like a restaked token that actually right now at least protects a lot the Ethereum itself. And now comes the complexity. So one, you can have different assets than ETH to restake with. So first are LSTs. So you already add like another layer of risk associated because it's already like inheriting the risk of the liquid staking protocol that you are throwing in, like Lido, Rocketpool, whatsoever. Then you can have a different asset like USDC, Bitcoin, wrapped Bitcoin, and so on. So then the complexity goes even further because you also have like the not denominated in USD anymore. Like the ratio between ETH and Bitcoin can matter over then a lot. And then you throw in the AVSs. So it's not only Ethereum, there are plenty of AVSs like oracles, it can be a bridge, it can be a ZK prover or something else. Then you add operators. Of course, this is actually pretty similar to liquid staking. And now imagine the 5D, because you're adding many restaking platforms. So we have EigenLayer that started, but we also have Karak, we have Symbiotic, we have Nectar, we have probably a couple of others that I'm not that much familiar with. So maybe now a question to the panelists, as you're like day-to-day operating in this maze, let's call it, what would you suggest to users, like people that restake their ETH or any other asset, but also the protocols, like how to navigate that? Because to the best of my knowledge, like Symbiotic and EigenLayer and Karak, they don't communicate with each other in sense of like the platforms, like they're pretty like isolated from each other. So do you have any like tips, like how to navigate that space?
Yeah, it's pretty difficult, I say. I mean, just look at 2024, like the points meta has been, the main craze. I'm sure we'll talk more about the point stuff later on. But everyone has a points issuance curve. A lot of it is, like a time integral of things. I think Symbiotic and EigenLayer have a fairly similar points emissions curve as well. If you look at how like these points, this implied yield has been trading on Pendle, I think back in January, the stuff was like 30–40% implied for LRTs, and now if you look at Mellow, it's like 15 to 20%. So, yeah, I mean, it's a little sad because, I guess with every single iteration that comes up, the expectation for future rewards comes a little down. Of course, like, while we all want to grow restaking, it's still like a fairly competitive arena in the sense that like, for a lot of these restaking platforms, your main objective is to still like acquire the main market share. Ideally, to develop the space, there is like an overarching like guidance at the very front. Like, hopefully everyone can like work together to like be able to like partition security appropriately, be able to like design the appropriate AVSs. What aspects of the collaboration, I mean, are the most healthy? I think these things can be further discussed down the line. But yeah, I mean, points are driving everything right now. Everyone needs to find their own issuance curve. It's pretty hard to find that issuance curve.
Yeah, I think from my perspective, with the presence of multiple restaking platforms that don't really communicate with each other, I think the advice I would give to protocols, more specifically, I think AVSs, is inherently, restaking platforms are permissionless in the sense that you can effectively list any asset on any restaking platform. Now, they may not host it on the front end, but it's completely feasible to do so. And with that in mind, the idea is that we have to be very conscientious about kind of double counting security, especially when we may rehypothecate the same assets in multiple restaking platforms. There's nothing inherently within restaking platforms that constrains that. And so the importance will be with AVSs and being very conscientious about what assets they decide to support, with LRTs, with communicating directly with users and with AVSs and node operators how they want to partition assets, like you were mentioning. And then on users to keep all of these actors accountable for making sure that they partition these assets. Because the worst case scenario is, we end up in a situation where a service that a lot of counterparties really depend on ends up having a lot less security than we implicitly thought, and could cause some kind of secondary failure in some other part of the ecosystem. I think there's also a lot of open room as well for kind of third-party innovators to come into this kind of sector of the space, building out dashboard. We've seen this already with like U-1 and a couple other stakeholders, building out dashboards for visibility on stake allocation and where exactly capital is being delegated. And I think that will only become more prescient and more important as time goes on, and these restaking platforms not only grow out their user base when it comes to AVSs, but also start to overlap in AVSs that use multiple restaking platforms at the same time.
So until very recently, EigenLayer was the only restaking marketplace that has been on our radar. But more recently, we've had to confront the reality that there are going to be competitors. The most prominent that's on our radar right now is Symbiotic, and it's still very early, so it's hard to know how that ecosystem is going to develop. But in the context of the work that we do with YieldNest, we're starting to do more research into the variations that you might experience between different staking marketplaces, because liquid restaking tokens will likely span the variety of options that are out there, and it is going to put a lot more pressure on us, I can tell you that, to understand what the differentiating factors are going to be. There is room for competitors to come in because EigenLayer, and to its credit, it's been very forward about that it is in development, that there are limitations that they're working on. That also leaves room for competitors like Symbiotic to offer a diversified option, which I believe that their stance is to try to create a more open ecosystem that has less checks, less guardrails. EigenLayer has certain guardrails. For example, the slashing. I'm blanking on the name of it. The slashing intervention council, something like that. And there are centralized committees that are in place to prevent some sort of negative accidental kind of slashing to occur, for example. And other marketplaces may forego some kind of guardrails like that.
Yeah, like how we're thinking about the emergence of multiple restaking platforms at Ebisu is like restaking is like a two-sided marketplace. There's supply looking to seek incremental yield on staking their asset, and then there's demand, which is like the demand side is the AVSs, and that's where the innovation is. AVS is like a huge design space that us as an industry is still learning. Like what apps can we better build using shared security? And I think that is like the key part to determine which restaking platforms quote unquote win. Like there's differentiators between the platforms, like the slashable assets or like different implementations of how to make AVSs. But at its core, I think they'll be competing for like the restaking platforms will be competing for the best AVSs teams that will demand a lot of security and ideally be profitable to pay rewards, because that's what's going to incentivize the supply to be retained on the platform. And there's like slight differences between restaking platforms. We've talked like Sol Layer, they're doing like Sol staking. There's like a Parasail doing Filecoin restaking. So there's some interesting things out there that cater towards different kinds of AVSs. But at large, like when we're looking at supporting liquid restaking as collateral, let's say we look at Melo on Symbiotic, the main question is like, where in the long run, where will the yield from Melo LRTs come from? It will come from AVSs, and which AVSs are choosing to build on Symbiotic. That's like the key thing we're underwriting. And I think it's interesting to like look at Symbiotic, how they're front-running EigenLayer in the sense of offering ERC20 token as slashable security versus EigenLayer just focusing on ETH and LSTs for now. Because like, for example, Athena is now trying to use Symbiotic for like staking the Athena governance token as slashable security for like their cross-chain product. And I think that's interesting because it highlights a need. It highlights Symbiotic serving a need of AVS better than EigenLayer. Like Athena has this governance token, they want use case for it, and Symbiotic's offering them a solution. So this is just like one example of how the restaking wars, quote unquote, will play out, where like platforms will cater towards different AVSs to try to win them over.
I think this question also ties very well with the other topics that we talked about previously, right? I mean, the first thing we talked about was the idea of LRTs being collateral, and the second thing we talked about was the idea of super risky AVSs. The sixth dimension that we could probably add to the 5Ds here are, how do we integrate LRTs with or restaking in general with like money markets in general, right? Obviously, someone has to be guiding these money markets as well. Otherwise, from a money markets perspective, from a lending markets perspective, they'll be incentivized to grow their lending market as fast as possible. That necessarily takes on a lot of risk. And of course, if they're not very scrupulous about that, that may cause the Alameda event that you mentioned earlier as well. So a lot of these things, I think that's probably just one of the trade-offs of decentralization in general, right? Along the way, we'll have a lot of hiccups, and hopefully the industry figures out the best way to solve them.
A question to panelists. How much of USD value has been slashed from Lido since the inception? You can be wrong by $1 million.
I'm doing the math. USD?
Yeah.
Today's
Zero.
prices? What's 900 times 4,000? Or wait, is it 4,000 ETH right now? It's 32 times about 300 validators, or like 280, I think, last time I checked. And I think most of them were Lido. And then I don't know what the 300 times 3,600 is. What? Carry the zeros.
Like 10K ETH?
Yeah, something around that ballpark.
That's very
Okay,
small.
answers.
I mean, I don't know. I didn't know it was 280 validators, but I mean, I'm not going to be doing mental
Oh, wait, there's
math.
280 validators in all of Ethereum, by the way, not Lido. I don't know the Lido specific number.
Okay, guys, give me numbers, because we talk about risk of slashing.
I feel like 1 million.
4 ETH. We have 4 ETH.
I feel like 1 million is a very small buffer here, right?
1 million, you have a buffer. Tell me the number.
10K times what? 3K, which is what, like 30 mil times 50%, say 15 mil?
15 mil.
20 mil.
20 mil. All right. Yeah, go ahead.
Yeah, I'll do halfway. Or you did what, 50% of 280? Oh yeah, I'm trying to think. How many is Lido? I don't remember. I'll do 25%. Somewhere closer, 10, 8 to 10
million. Okay, you can probably write like a program to calculate whatsoever. The reason I'm asking you this question is because I was running a very similar panel at Token 2049 in Dubai, and there was Marcin from Lido, and he told me that the amount that has been slashed since the very beginning is like below $500,000. So that's the reason I gave you a margin of 1 million, because everything below is actually a correct answer. So congrats, Wormhole. You are winning like a Redstone socks as like a small gift over here. Congrats. And now, as for the panel, don't you think this was like one of the most fundamental questions to begin with? Like how much was slashed with the biggest liquid staking protocol out there, right? So this is probably the first proxy we should look from at LRTs. And we know this is like already 6D, and probably you can plot like 7D, 8D in LRTs. So now, it is a thesis, not a hypothesis, that LRTs are way more risky than liquid staking tokens. And in any market, when there is a risk, higher risk, there is a national product to cover that, which is called an insurance. So how would you guys talk about underwriting the risks of AVSs and liquid restaking? Do you think these kind of products could make sense? Are we going to see like Nexus Mutual of like liquid restaking or restaking as the whole? Any thoughts about that?
I think I have a specific take here. So when most people build products around LRTs, I think inherently, or protocols, not products. When most people build protocols around LRTs, I think inherently one of the implicit responsibilities of the protocol is to kind of assume some kind of default risk and then to build into their fee model a way to kind of, create a cushion there. Lido does that with the insurance fund. Aave does that with the safety module, et cetera, et cetera. Maker, I think, has a proxy. So I think for pretty much anyone who's underwriting these LRTs, the question is on kind of how they should parameterize that. The way I think about it, and the way I hope like most LRT and DeFi protocols think about it, is taking into account this idea of not trying to underwrite these assets on the same ways that we underwrite traditional financial products. So taking into consideration that this is a new class of assets, this is a new class of risk, and going to speak with the stakeholders who are most familiar with this type of risk and these types of assets, the people who understand consensus protocol architecture at a low level and understand and know how to model out collusion risk for DA systems, right? Who understand and know how to model out collusion risks and proof of stake systems and DPoS systems, because these types of questions and these types of kind of discovery around system design is what's going to be required in order to actually build comprehensive modeling and mechanisms that can actually counteract and build a sort of cushion for customers when it comes to these types of assets.
I think, insurance might actually be a good use case for an AVS itself, right? I mean,
And then you have this Spider-Man that is pointing on each other, right? Like Spider-Man pointing on Spider-Man.
But to go back to your original question in general, I feel like in the end, I asked a similar question yesterday actually, for like Morpho and Aave, whether or not this was actually necessary to use an insurance layer within the protocol itself. This is actually probably a competitive point LRTs can, sort of compete on. One LRT can be like, hey, we have the best risk management services, we're not going to get slashed, we actually don't need an insurance fund because theoretically to maintain the insurance fund, you have to consistently pay out, right? Which naturally dilutes your yield. Others might feel like, hey, we want to gamble as much with our selection. Here's an insurance AVS, people staking here, you can collect a lot of fees, but you'll get like really hit when we get slashed as well. So I feel like the marketplace in general would be quite efficient on this matter, so it's an interesting question.
At least for like CDP stablecoin protocol, the way it's not insurance, but the way the mechanism that is baked into the stablecoin that adjusts for the risk of like LRT slashing or LRT depegs is like over collateralization. So when we look at CDPs collateralized by less risky assets like Ether LSTs, the minimum collateralization ratio per debt position is lower. But to account for that, the incremental risk of AVS slashing and LRTs, smart contracts risk, liquidity risk, et cetera, the MCR has to be much higher for loans against liquid restaking tokens. So I guess that's not really insurance, but it's how us as a CDP protocol is trying to account for that incremental risk. And that should be, at least for us, like editable via governance. That parameter should be able to change as we get more information about the risk profile of these LRTs.
Yeah, and from my perspective, I kind of come from the same place where I'm interested in understanding from the lending platform or the stablecoin platform's perspective when they're considering assets for onboarding and how to properly mitigate risks related to those assets. There's a lot of proactive measures that need to be taken, and there's a certain treatment in how liquid staking tokens have been treated in lending platforms that Marcin I kind of wanted to share with you and maybe get your perspective on it. It's become pretty common for many of the major platforms to use the internal rate of the liquid staking token as the oracle instead of using the external marketplace. And the rationale is that because the liquid staking protocol is the primary market, that as long as it maintains its solvency, you can have a certain guarantee that it should have the value to be able to pay out ultimately. So you may have situations where the lending platform takes on bad debt, but as long as the solvency is maintained, the protocol ends up earning fees off of its willingness to take on that temporary bad debt or that temporary risk. But with LRTs, they may have different properties that we can't treat them in a similar way. For instance, there is a mandatory 7-day withdrawal period from EigenLayer, and that may interfere with the LRT's ability to keep its peg at all times, and that may introduce more instability that requires the lending platform to treat it differently in its onboarding. But I'm kind of curious, I mean, since you are from Redstone and you're an Oracle provider, how you see the treatment of LSTs and LRTs, and not to put you on the spot as the moderator, but putting you on the spot.
Okay, wait. Let me put my panelist cap on. Okay, now I can talk as a panelist. Talking quickly, because I'm not the one that should speak on that. In LSTs and LRTs, you have two major approaches of pricing the restaked or staked asset. Either you can look into the smart contract, where people put in the staked asset. Let's take Lido. You put ETH, you get staked ETH, you can then wrap it for wrap staked ETH, and in the contract, you can see the exact exchange rate between staked ETH, that should keep the peg of ETH, and wrap staked ETH. And there is also like information of how much ETH is staked. So you can kind of like derive the price from how much assets are deposited into Lido smart contract. Or you can look on the market price. So you look on DEXs and centralized exchanges, and you see how the market prices this particular asset. Because in the event of a Black Swan event, imagine, I don't know, half of Lido blows up, then probably the price derived from the contract can be fraudulent, because, I don't know, it can report that there's still 100% of assets, and let's imagine 20% of assets is gone because of whatever haggle, whatever situation, then the market price will probably reflect that, because people will realize and will trade this asset at a discount, right? So there's always a trade-off, but then you have to keep a very high liquidity of this asset on DEXs and centralized exchanges volume, let's say, to make sure, like, when there is a huge liquidation on a lending market or CDP stablecoin, you can also liquidate that without getting like enormous slippage, right? Because if you have, for example, one DEX pool with, I don't know, 3 million of liquidity, and you get a liquidation of $10 million, now how are you going to sell it on that DEX without like enormous slippage? So there is no like a silver bullet over here. Our approach is to mix both. Our approach is depending, like, in the end, it's the lending market or the CDP stablecoin that should understand like how our price feed works, right? Because they are the one that create their protocol, and it's not that all lending markets, all CDP stablecoins are the same. Like, they have a lot of like differences between each other, and they are very, very much different in liquidations, whether they are actually running 90% of liquidation bots, or they try to like democratize liquidation bots, how they're operating and so on. So my take, if you ask Redstone, would be you should get both, and you could create like conditions depending on how big of a liquidation it is, what the protocol is, what's important for the protocol. Is it like that the LR loan-to-value ratio can be like lowest or highest, right? Depending like how you calculate that. Or would you like to be protected against the Black Swan event? So if everything blows up, you're the one that is standing still and saying, hey, I survived, right? So, yeah.
Yeah, to add on to that, we are a lending platform that does use the exchange rate oracle, and also uses Redstone to use price oracles at the same time. And we actually built a hybrid model for it that we're the only lending platform that does this. So specifically what we did was we only liquidate on the basis of the underlying ETH backing any one asset, right? Because we're focused on only ETH to ETH derivative-based loans, so we don't do any kind of, we don't internalize any type of market risk, right? There's no ETH to USD or any type of internalization of alternative assets. That's the constraint we impose. And so what we do is we price everything on the basis of on the basis of this idea of solvency. And in portions of time where markets are volatile and you'll see prices move a lot, let's say the Renzo DPEG, what we do is we limit the amount of debt, new debt people can issue with a price oracle. Basically limiting the ability to effectively arb out the lending liquidity in the pool and basically block out new users from using the platform, kind of dampening the volatility in the system. And so what this does is you get the security guarantees of you're not going to get mass liquidated on the basis of an event like Renzo where they were perfectly solvent. There was just some market turmoil about their airdrop, which had nothing to do with the actual asset. And then two, you're able to also make sure that the people who are using the platform can kind of trust in the platform's stability, even in the case of those market turmoil events. And what we do is kind of focus on this idea of pricing duration risk, right? And we have mechanisms inbuilt to the system, such as the protocol can effectively internalize a liquidation by directly withdrawing through the beacon chain. And then paying back lenders the kind of full price if the market price goes down and you can't exit through a DEX. And we also have like a counterparty system where we can route liquidity to solvers like these large market makers and off-chain liquidity providers who are willing to take on this kind of duration risk and these duration bonds as a new source of order flow. And are willing to kind of underwrite these different kind of like duration risks that doesn't really exist with traditional assets.
Unfortunately, I got a notification that unless we leave the stage in a minute, there's going to be a trap opening beneath us, and we are going to, go to the cellars or whatever. So over here we have to stop. Whoever wants to talk deeper about LRT, stablecoins, risk associated, please catch all the panelists after the session outside of the room because there's going to be the next one. I want to say thank you very much for joining the panel. Super interesting stuff, and also thank you the audience for being interactive. It always helps. And with that, I would like to finish. Thank you very much.